Hello, everyone. We'll just wait a couple seconds and let a couple more people get in. Hi, everybody. Thank you so much for joining us for our October webinar. I'm Betsy with Elevate Wealth Advisory. And today we are going to be talking about year-end planning, everything you need to have in place before the end of the year to make sure all your finances are in check. With me is Brian Rosso, our Director of Operations and one of our wealth advisors here at Elevate. Hi, Brian.
Hey, Betsy. Thanks for having me.
Yeah, good to have you. Brian's had a lot going on lately, and he just welcomed a new baby boy, the fourth one. He and Heather have a new little one at home. So that's been a big addition. And then also, since Brian joined us last, he has secured the title of Best Financial Planner in Athens by the Reader's Choice Award. So congrats on that, Brian.
Thank you. Yeah, it's been busy with Bo and our newborn. He's now 8 weeks old today.
Oh my goodness. Time flies.
It does.
Well, I will let you get started. And then for everyone watching, if you have any questions, feel free to drop them in the chat box, or you can email them to marketing@elevate-wealth.com, and we'll make sure that Brian gets your questions answered. Thanks, Brian. We'll let you take it away.
Great. Thank you, Betsy. Let me share my screen here. All right. So thanks for everybody for joining today. We wanted to kind of give you a recap and some things you might want to be thinking of as we go into year end. Year end planning can mean a lot of different things to a lot of different people. So we're going to cover a lot of content today, but hopefully you can take two or three things and apply it to your own situation. So overall, what are we trying to accomplish? What's some of the important things of year-end planning? Number one, I think we can do a job of identifying some opportunities that will maximize your taxes over your lifetime. Sometimes that's not always minimizing the taxes today, but how do we minimize them over you and your family's lifetime? Build confidence in understanding some of the impact of the changing laws that we've had. This year, President Trump and Congress signed in the One Big Beautiful Bill, and there's a lot to it. It's over 1,000 pages of tax changes, updates, some things new, some things have just been modified, and some things have been made permanent. And so we're going to talk through some of those and how might that impact you going into 2025. Kind of the unique thing about that legislation is it was passed in July and it impacts you in 2025. So what are some of those things that maybe we should be mindful of as we head into the back half of the fourth quarter? And then also, how can we improve just our current or future financial outcomes? You may or may not have access to different retirement plans. Some require you to contribute before the end of the year. Some of them you have a little extra time. We'll go through which ones give you that extra time and which ones maybe you need to make some extra contributions to this year. And then also life changes. Life is never linear in most cases. And sometimes it's expected and sometimes it's not. And so based on job changes, family changes, health changes, how can we be prepared heading into year end to make sure that we're well equipped? And then for today's agenda, we're going to be talking about some of these planning items. The One Big Beautiful Bill, we'll touch on that, some different tax traps, some planning deadlines, both year end and a little bit after year end, just so you kind of are aware of those. And then maybe some tax strategies, some gifting and Roth conversions, some strategic moves that you can make this year in 2025 that will set you up in a better place next year. So first, let's talk a little bit about the One Big Beautiful Bill. And I really divided this into three sections. Again, it's over 1,000 pages of material. So obviously we can't cover all of that today, but I wanted to break it down into what's completely totally new, what's been modified a little bit, and then what's either stayed the same. And so for here, what is totally new? And there's been a lot of talk about, is Social Security going to be tax-free? There was a lot of talk about that. Unfortunately, that didn't pass, but one thing that did is an extra senior deduction. And so now seniors are going to have a $6,000 per individual extra standard deduction if you're over the age of 65. Now, there's a caveat here. There's an income phase out. So if you're a joint filer, it begins to phase out above 150,000. But it's really nice to know that seniors over the age of 65, as long as they're under 150,000, are going to get an extra $12,000 in standard deduction. So that's great news. Also, another thing that was talked a lot about in the campaign was no tax on tips or overtime. And this is one thing that actually was enacted in the One Big Beautiful Bill. There's $25,000 of either tips or overtime pay that is now tax-free or tax deductible. And so that is also good news. So before, in order to get a tax benefit for giving to charities, you had to itemize. Now they've added in for 2025 or the beginning of 2026, for married couples, you can give up to $2,000 tax deductible. So even if you're still taking the standard deduction, you're able to give out of your checking account or to some other charities, not itemized, but still get a tax benefit from it. So that's also some good news. And then the last one here is I put Trump accounts. Betsy mentioned that my wife and I had our third baby this year. And so he's going to now get a Trump account. And what that is they're going to deposit $1,000, a seed account, which is kind of structured like an IRA, and it's allowed to grow. And at the age of 18, that's going to be converted to a traditional IRA. The Treasury is going to be kind of managing this. They said it's going to be pegged to one of the major indexes. So it will be invested in the market. It'll be allowed to grow. We can contribute to it over time. So I've looked into this a lot. It's kind of unclear exactly how to see it. Obviously, we're not going to have control of it. It's meant to allow for students to have a pool of money and then allow it to grow. And at the age of 18, then you can either use it for certain expenses or college education. But just know that this is still kind of a new thing and they haven't quite ironed out all of the details with this. But just know from 2025 to 2028, any newborn U.S. citizen will be getting an initial $1,000 into an account that will grow over their lifetime until age 18. So what's meaningfully different? Again, not going to cover everything here, but a few of the things I wanted to touch on. Number one is the state and local taxes. This is called the SALT deduction. This was capped at $10,000 per year for married filing jointly. They increased it to $40,000 starting this year. This is really going to impact some people's taxes that may have some Airbnbs, may have some rental properties, may have multiple houses in different states, maybe a beach or a lake house. Those ones that are paying really high property taxes really weren't getting a benefit from that in the previous laws. But with this one, it really quadrupled it, right? So going from 10,000 to 40,000. So that could be a significant tax benefit for those individuals. Obviously, that's not going to apply to everyone, but that is something that's new. The alternative minimum tax, that's also been modified a little bit. It may affect more people at the past. It's really kind of reverting back to the 2018 levels. Also, the adoption credit. So families will now be able to get up to $5,000 refundable starting in 2025. Again, attempt to kind of reduce taxes there. And then there's some green energy credits that are expiring. There's been a lot of talk about EV sales. I think there's a $7,500 credit that expired in September of this year. And so some of these things are rolling off. There were some incentives and tax deductions for things like solar panels, efficient HVAC units, windows, that sort of thing. They all have different timelines of when those are going to be phased out. So if that's something that you're looking at doing in 2025, just be mindful that there are some cutoff dates on when you can apply those improvements. So what's kind of mostly staying the same? In President Trump's first term, he kind of readjusted the tax brackets. He created the 22% bracket. And those are pretty much going to stay the same. And he's made those permanent. And so we have the 10 to 37% tax bracket. There was a slight bump in the brackets themselves. So hopefully that may reduce taxes a little bit. But based kind of on the inflation adjustments they're putting on each bracket, in 2026, the 22% bracket, which was a new bracket in 2018, is going to be shrunk just a little bit. Also, standard deduction is pretty much staying the same. Again, this is one of the things that in President Trump's first term, he doubled the standard deduction. He actually increased it a little bit with the One Big Beautiful Bill. And so if you're married filing jointly now, the standard deduction for 2025 is $31,500. Also, the child tax credit, that was at $2,000. That was bumped up a little bit. It's mostly staying the same, but they did bump it $200 per child. So a tax credit is a little more favorable than a tax deduction. That will reduce your tax liability by exactly that amount. So for each child, you'll get an extra $200 in savings on taxes. And then the QBI deduction. There's some higher income phase outs for this. Typically, this impacts people who are business owners. This was one thing that really was tax favorable in the first round. So what they did is they kept it, but they extended it and increased some of the phase outs for the QBI deduction. And that stands for qualified business income. Okay, so let's move into just some planning items kind of prior to year end. October 15th to December 7th. This is going to be what we consider your open enrollment for Medicare. It's really an opportunity to make changes to not only your healthcare, but also drug coverage. It's always important. There were some big updates in 2025, maybe not as significant for 2026, but it's always important to go in there, even if you don't plan on changing plans, just making sure that if you are on things like certain medications that you know are covered, making sure that those didn't get dropped off of that plan. So there is a tool where you can go in there, put each one of your medications, put your doctors in for your health coverage plans, and just make sure that nothing has changed. And again, that open enrollment is from October 15th to December 7th. From November 1st to January 15th, that's open enrollment for the Affordable Care Act plans, the ACA plans, or Obamacare, as some call it. And it is good to note, though, that if you want your coverage to start January 1st, December 15th is the deadline. But they do give you up until January 15th to make a determination on what plan you want. It's just knowing that your coverage won't start till February if you wait till after December 15th. Another good thing to think about as we head into year end, some people will do some estate planning many years in the past and kind of forget about that. End of the year is a really good time to look at those estate documents, figure out what you have, see if it needs any updating. There's 3 documents that we feel that everyone should have in most families. The first one is going to be the last will and testament. And to us, the last will, it outlines how a person's assets should be distributed after their death. The second one is a power of attorney. And this is just going to give someone during your lifetime while you're alive, it appoints someone the authority to make some legal, financial, and medical decisions on your behalf. And then lastly, the third important document that we feel is what's called an advanced healthcare directive or living will. And this really outlines what your wishes are for specific medical care if you're unable to communicate them. And so we feel that these are 3 really important documents that everyone should have. And end of the year is just another good time to go back and make sure that nothing needs to be updated. So let's think about some deadlines for December 31st. So if you're required minimum distribution age, you'll need to take those before December 31st. So if you're born between 1951 and 1959, your RMD age is 73. And if you're born 1960 or later, your RMD age is going to be 75. So what types of accounts am I required to take RMDs from? So traditional IRAs, and some employer sponsored plans, 401ks, 403bs, 457 plans, some tax deferred annuities, SEP IRAs, and simple IRAs. Now, if you're still employed, let's say you're RMD age, you're still employed, and you're still contributing to, say, a 401k, that until you separate service from that employer, you don't have to take RMDs from that plan. But the rest of these you would. So as long as you're still working for that plan and contributing, you don't have to take an RMD for that one. But just know that if you have some old 401ks or a traditional IRA or some of these other account types and you are RMD age, you have to take your RMD before December 31st. Also, inherited IRA RMDs, and this is specifically for non-spousal. So there's a few considerations. If you inherited an inherited IRA before 2020, and again, non-spousal, the beneficiary can do the stretch rule, and that allows you to take smaller RMDs over your lifetime. The second way, which is now post 2020, so if you've inherited an IRA after 2020, you're subject to what's considered the 10-year rule. So you have to take annual RMDs based on the beneficiary's life expectancy. So these are typically going to be higher amounts than the stretch rule. And the other caveat with this new rule is you have to withdraw the full account balance within the 10-year period. And so this kind of presents some planning items of when and how should I start to pull out. If you're only taking the annual RMD, you're typically going to end up with a large pool of money at year 10 that you have to withdraw. And so thinking about how and when and strategically pulling out these can be important in making sure that we're minimizing taxes and not having a big tax burden in that year 10. So some other items to consider before the December 31st deadline. Again, some other employer-sponsored plans, these 401ks, 403bs, 457s. If you plan on contributing more to those, that has to be done before December 31st. So some charitable donations and gifting. We'll talk a lot more about this. There's always a lot of questions about gifting and to maybe a family member, and so we'll cover that. And then some Roth conversions. Also looking at maybe some tax opportunities, tax loss harvesting. And a lot of times we get asked the question, what exactly is tax loss harvesting? What it's really doing is it's realizing losses in a year where you can then offset capital gains or even offset up to $3,000 of your taxable income. If you have more than $3,000 to offset, that additional losses is carried over to following years. And so you can use those in more than just 1 year. And the other important distinction for something like tax loss harvesting is you want to sell something at a loss, but buy something that's not identical, but similar. That way you don't miss out on market returns, but you're able to capture that loss and use it to offset taxes. There is a wash sell rule. So if you sell Apple stock and buy Microsoft, you're not allowed to buy the same security that you sold at a loss within a 30-day period. And if you do, the loss that you took on the first security is actually disallowed. And so that's a important rule and distinction that you want to. That's why when we say you want to buy something that's similar, but not necessarily, it can't be identical, because then you'll fall under the wash sell rule. Also, if you do have some securities that have large gains, maybe it's smart to spread some of those sales out over multiple years. And that does a couple of things. It could potentially realize a lower total tax liability from doing that strategy, spreading out a sale over multiple years. And you can also determine to delay a tax event. So here we are approaching the end of the year. If you're looking at selling something with large gains, maybe it makes sense to delay an extra couple of weeks so that you essentially delay the taxes for another year. So not everything has a deadline of December 15th. So some of these items are going to be actually when you file your tax return or April 15th. The first one is HSA contributions. Now, in order to be eligible for an HSA, you have to have a high deductible healthcare plan. And what qualifies as a high deductible healthcare plan? Well, first you have to meet the annual deduction minimum. So as an individual, you have to have a minimum of $1,700 deductible and $3,400 for family coverage. But your out-of-pocket maximum has to be less than $8,500 for an individual and $17,000 for a family. So there's kind of a window there that we're looking at. It has to be a minimum deductible, but your out-of-pocket maximum cannot exceed these levels. And if you're eligible, then you can contribute to an HSA plan. Also, you cannot be on Medicare and contribute to an HSA. So what are some of the maximums that we could contribute to an HSA account? For a single, that's $4,300 a year. A family is $8,550. And then if you're over the age of 55, you can do an extra $1,000 catch-up contribution. And if you have access to an HSA, I would highly recommend it. It's one of those accounts where you get a tax deduction to put dollars into an HSA. And most of these, you can even invest it, allow it to grow, tax deferred. And when you pull money out of this, as long as it's used for medical expenses, which we all know how costly those can be, it's tax free. So it really gets a triple tax advantage there. So if you have access to an HSA, by all means, maximize it. It's a great tool to be able to use that. So some other April 15th deadlines, we have traditional and Roth IRA contributions. And these are going to be unchanged. The amounts are unchanged from 2024. So you can contribute a $7,000 max contribution to either a traditional IRA or a Roth or a combination of the two. Sometimes we get asked the questions, can I max out both? Can I put 7,000 in traditional and 7,000 in Roth? And the answer to that is no. But they are individual accounts. So if it's you and your spouse, you could both contribute. And then if you're over the age of 50, there's a $1,000 catch-up contribution. 529 contributions also give you a little extra time to be able to contribute. And this does vary on state to state. We're in the state of Georgia, so they allow up until the April 15th deadline. There's a lot of different 529 plans. Most states have their own sponsored plan. We recommend the Path to College, especially if you live in the state of Georgia, because you get a state tax deduction. If you're a single filer, you can deduct up to $4,000 per beneficiary, so per 529 account. And then if you're married filing jointly, you can deduct up to $8,000 per 529 beneficiary account. And again, this isn't deductible at the federal level, only at the state level. So gifting, really we think about gifting and dividing it into two separate types. We have what's called non-charitable gifting and charitable gifting. Non-charitable gifting is going to be giving to family, friends, other individuals, and organizations that are not recognized as a 501c3 in the IRS's eyes. Charitable gifting is going to be giving to things like church, nonprofit organization, universities, endowments, school district programs, and these are all going to be required to be 501c3 organizations. So first, let's take a look at how non-charitable gifts affect your taxes, or if they don't. One common question we get a lot is, will I have to pay for taxes, or do I get a deduction on non-charitable gifts? And the answer to that is no. So you don't have to pay taxes, which is a good thing, but you also don't get a deduction for gifting to non-charities, right? If you give your family member $10,000, again, not taxable to you, but you also don't get a deduction for that. So also, and we kind of covered some of these bullets, but again, not taxable and also there is no deduction for that. So there is a tax gift exclusion limit. And so that can throw some people off. For 2025, that's $19,000 per person. So if you're a married couple giving an individual money, $38,000 is the limit that you can give without doing the gift tax exchange. If you give over that amount, that's okay. It's still not taxable. It's still not tax deductible. But I think people see these limits and say, okay, if I give over that, then that means I'm paying taxes. That's not the case. So if you do decide to give over $19,000 to an individual per person, again, not taxable, but you just have to file what's called a gift tax return, and that's IRS Form 709. And what does that actually do? So when you file that return, say you've given, an amount over 19,000, that amount over the $19,000 number is just subtracted from your larger lifetime limit. The estate tax is really high these days. Today in 2025, it's 13.99 million per person and 27.98 per couple. And so that extra amount over the 19,000 just gets counted against your lifetime maximum that you can give. Now, if your estate is really high, that may impact you, but for most individuals, doing the Form 709 doesn't really necessarily mean that anyone will owe taxes in the long run. Charitable gifting. So there's a few different forms of charitable gifting. You can give things from your checking account. You can give cash. You can write a check. These may be tax deductible if you're itemizing. Luckily, this year, with the new One Big Beautiful Bill, you can deduct up to $2,000 of gifts, even if you don't itemize. Again, where you really start to see a benefit of giving larger gifts, though, if you're over that $2,000 mark, you've got to meet the standard deduction hurdles before you get an additional tax benefit. And so married filing jointly is $31,500, single is $15,570, and then head of household is $23,625. So again, if you're given between $2,000 and the standard deduction, again, you're benefiting a charity, which is a great cause, but you're not necessarily getting a tax benefit for that. So if you're very generous in a certain year and you want to give a lot of money, just know that there is a deduction limit. You can only deduct up to 60% of your adjusted gross income. So we talked about giving cash and checks. That you can also give what's called appreciated securities. So if you have some investments that have grown a good deal, maybe it makes sense to gift those appreciated securities. There is a limit, though. You can only gift up to 35% of your AGI. This was a little bit modified in the OBBA legislation. It was 30, so a little bit of an increase there. Some advantages to giving securities over cash is you avoid paying capital gains tax, and you get to also deduct the full market value of your gift. So for example, let's just say that you've purchased a $10,000 in Apple stock 20 years ago. And today the current value is $100,000. So option one, you can sell that $100,000 of Apple. You pay long-term capital gains tax, which for most is 15%. So $15,000 in taxes, and you give the charity the remainder. So $85,000 to the charity, and you get to deduct that $85,000 gift on your tax return. And again, this would be considered a cash gift because we sold the securities, accrued the tax, and gave it to the charity. Option two is if we transfer these appreciated securities, again, we've got the same $100,000. We can transfer it to what we call a donor advised fund or directly to the charity. There's no tax consequences to do that. And you can fully deduct the full $100,000. So again, much better situation here. If you do have that as an option, the charity gets the full $100,000. You have saved $15,000 on taxes. So it's really a win-win all the way around. So some other charitable gifting strategies. One that we use a lot with clients is called bunching. And let's say you give $5,000 to $10,000 a year over every year, and maybe you have a really high income year one year. You have a big bonus or you sell a business. Sometimes we'll use a bunching strategy and say, okay, how many years are you going to be gifting that amount of money? And does it make sense to gift it all in one year so that we can get a tax benefit for doing so? One way we do this is through a donor advised fund. And this is just a charitable account. When you contribute to a donor advised fund, you've given up ownership, you have control over it. You can do what's called granting from that account. But if you give $100,000 there, you don't have to give it all out at once. You can do it over multiple years as you intended. But it's a good way to go ahead and give up ownership of it. So you get the tax deduction in that year. And then again, you've got the flexibility to send it to the charities that you want to support. So there's really three big deductions in determining if you're going to itemize or if you're going to take the standard deduction. The first one is mortgage interest. If you've got high mortgage interest, you can deduct that. The second one is charitable giving. And again, you can see that that complements here with the bunching strategy. If you do plan to give a lot in 1 year, you can get a tax benefit from that. And then the third one here is state and local taxes. So property taxes, sales, or income taxes. This is one that has been increased for this year. And that's why it's kind of highlighted is now instead of a $10,000 limit, which is what we had in previous years, it's up to $40,000. So this can be definitely one that could be a significant increase for some. There's also some other major deductions, although not quite as common, but just know that if your medical expenses are over 7.5% of your AGI, you can deduct those as well. So just know that is an option. Also, losses from things like natural disasters, flood, hurricanes, and even theft. So if you have significant losses from any of those are also tax deductible. So another charitable gifting strategy is called a QCD, or qualified charitable distribution. And to be eligible for a QCD, you have to be at least age 70 and a half. And essentially what we're doing is sending a payment to a charity directly from an IRA, and it has to be done from an IRA. There is an annual limit to do this. It's $108,000 per year. But there are some really good benefits of doing QCDs, and we'll touch on those now. So here's just an example of if we do a non-QCD gift versus a QCD gift and the potential tax savings. So if we're age 70 and a half, and we've got an IRA at our disposal, how can we potentially get some tax savings and tax benefit from that? Option one here is a non-QCD gift. The charity, you gift the charity $10,000 from, say, a checking account, or you pull it out of the IRA. It's reported as income, $10,000. The tax bill on that at, say, 24% federal is $2,400. So the total cost of that gift, even though you gift the charity $10,000, it costs you $12,400. Versus if we just issue it directly to the charity from the IRA, charity gets the $10,000. $10,000 is actually excluded from your taxable income. And so that means that there's no tax bill on this distribution. And so it has saved us now $2,400 using the QCD option. Really, there's only a few ways to get, really only one way to get money out of an IRA tax-free, and it's to give it to charity. And the QCD method is that avenue to do so. And so if you're charitably inclined and 70 and a half, or approaching that age in this year or next year, this is a great strategy and a good way to save taxes and maximize your gifts. Another tax strategy is a Roth conversion. Now, a Roth conversion is when you take dollars or money from a traditional IRA and convert it to a Roth IRA. And in doing so, that's a taxable event. You're going to pay taxes on the amount of money that you converted, but after that, your earnings and future withdrawals are going to be tax-free. So what are some reasons why we might want to do this? Again, tax-free growth. IRAs are subject to RMDs. Roth IRAs are not. So it's going to reduce our RMDs for those traditional IRAs when we are converting. Possibility of lower lifetime taxes. Again, does it make sense to do a Roth conversion? Sometimes it does, and sometimes it doesn't. It's really an annual strategy based on income, which tax bracket you're in. Are you using other deductions? Are you itemizing? So this is not necessarily a standalone strategy. You really have to consider everything within your household to make sure that it makes sense to do a Roth conversion in each year. But the overall goal is to lower lifetime taxes. And then it can be also a really powerful estate planning tool. If you inherited IRA after 2020, we realize now that we have to withdraw these accounts within 10 years. And so that can be a blessing to some, but it can be a really big tax burden based on the people who inherit this account. And so when we convert these to Roth IRAs, they're inherited by non-spouses. They're still subject to RMDs, but they're going to be tax-free. So again, Roth IRAs are passed on to heirs tax-free. So it can be a powerful estate planning tool if done properly. So some Roth conversion strategies, we call this one filling up the bucket. And really essentially what it's doing is looking at your tax bracket, looking at your sources of income, your deductions, and how much room do we have in that bracket to fill it up with income to maximize each one of these tax brackets. Again, this can be opportunistic. We can take advantage of low income years. If one spouse has a lower income year, if one retires, maybe Roth conversions make sense. Maybe you are both retired. We call that period transition, where you really have a lot of flexibility of when and how you pull income. So is there a way to build your income stream, get the income you need, but keep your income very low so that we can do things like Roth conversions? Market downturns, again, you're not forced to do a Roth conversion. You can do it anytime within the year. So if you see a significant market downturn, you can convert a higher percentage of your IRA. And then once it's in the Roth IRA, you get the tax benefit of that growth being tax-free. But in doing so, and doing something like a Roth conversion strategy, we're realizing and taking additional income. And so when we do that, we will also want to be mindful of potential tax traps that may come of that. And if you're on Medicare or within 2 years of going on Medicare, we want to be mindful of what's called the IRMA. And that is the income related monthly adjustment amount. And it's really a surcharge or an extra tax on your Medicare premiums. So here we have a chart. As you can see, the 2025 adjustments are going to be based on the 2 years prior. Okay. So again, 2025 is based on your 2023 income. And so if your income is below 212 or less for joint household, you're going to pay the typical Part B premium of $185. And then you're going to have no extra adjustment for Part D, which is your drug plan. Now, as you start going down in these brackets, as your income increases, you'll pay an additional tax on your Part B premium and on your Part D drug plan. And this is going to be per person. So if it's married filing jointly, this will be per individual. And one of my pet peeves is these brackets, these IRMA brackets that we have to be mindful of, do not line up with the income brackets that we saw on the previous page. And so when we're taking additional dollars of income, we've got to be really careful, or at least mindful, that if we do take an extra dollar of income, although it might be in the same tax bracket, it might trigger one of these IRMA surcharges 2 years down the road. And again, it just takes some proper planning and being mindful and intentional about when and how much you're converting or taking additional income if you are. Another tax trap when realizing some additional income is called the net investment income tax, the NIIT. And this amount is going to be based on your modified adjusted gross income. That's your AGI. And then you have to add some things back like capital gains, dividends, taxable interest. So those are some of the categories that are included in this. So if you've got rental property and rental income, this is going to be subject to that. Any type of passive income in a partnership, capital gains, other dividends. So if your income is above $250,000 and you have these sources of income, you're going to pay an additional 3.8% tax on the excess over the $250,000 mark. Again, another thing just to be mindful of, if we do have lots of other sources of income and we do something like a Roth conversion strategy, just being aware that, hey, we may end up paying an additional tax next year or this year for taking that income. And then lastly, just wanted to highlight, this is our 2025 financial planning checklist. Obviously, we went through a lot of different topics today, and we partner with a lot of partners, and this is their kind of financial checklist for the year. It goes over taxes, investments, milestones. Again, wasn't able to cover everything today. I hope you took away something that you feel is going to be useful to your situation. And I believe we have copies of this financial planning checklist. So if you're interested in getting a copy, just please reach out to us, Betsy, our marketing inbox. So if you want to tell everybody about that, I'll hand it over to you. But thank you guys, and I appreciate you all for joining.
Thank you so much, Brian. That was great information. Not just year-end planning tips, but all of the One Big Beautiful Bill Act updates. That was just fantastic. We do have copies of this checklist on our lifelong learning library on the website. So you can go to elevate-wealth.com and you'll see at the bottom lifelong learning library, or it's under our resources tab. You just put in your name and email address and you can access this and our key financial data card and other documents that we have there that are helpful. We did have just a couple questions. It's just a reminder. Somebody asked if you could repeat the deadline for Roth IRA contributions. Is it the end of the year or is it April the following year?
Good question. So you have until April of the following year. Yeah, it's not December 31st. If you've got an employer-sponsored plan, it is December 31st, but things like a traditional IRA or Roth IRA, they actually give you until April 15th.
Okay, excellent.
Of the following year.
Wonderful. Thank you. And this is going to be recorded and on our YouTube channel later today. So we'll post that, and I'm going to send everyone who registered a link so that you can share it with your friends and family. Please do share it because this is great information. And if you are not a current client and this is information that you're interested in, want to learn more about, we will hold a complimentary consultation with you. All you need to do is go to the website, again, elevate-wealth.com, click Let's Talk, and we will get you scheduled with one of our advisors to talk more about how we can help you. Thanks so much, Brian. We really appreciate it. And next month, we'll be exploring the charitable contributions information, a little bit of a deeper dive with Rob Fazekas. So if you're interested in that, just go to our website and sign up for that one as well. Thanks so much, and we'll see you next month.
Thanks, Betsy. Thanks, everyone.
And thank you. Bye-bye.
All right. Bye-bye.